Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are starting off this week, after what has been a pretty roller coaster experience for equity investors over the last, call it 3 or 4 weeks, where we made a new high a couple of weeks ago, and it seemed like things were really starting to fall apart here last week with now the news of the breakthrough with the government shutdown driving sentiment back into the positive again, starting off this week. We saw the markets up, a significant amount yesterday, and we also see it again here today. If you look at kind of the S&P 500, we respected the 50-day moving average. So as you can see, that 50-day moving average, which has been prior support here, was prior support here again as of Friday's close, and we bounced off of that. And that pretty much continues this upward trajectory, this upward trend that we find ourselves in, and continues the bullish momentum that we see here for equities, which, like I said, seemed like that was starting to fall apart here last week. Clearly, buyers buying that dip from last week and seeing that as an opportunity. We see it across the major indices. We see it on SPY. We saw it on QQQ. Same thing here, as you can see, respected that 50-day moving average, bounced off of it, actually generated a bullish trend following signal here today, or I'm sorry, at the end of yesterday. If you look at small caps, what's interesting here is that the small caps hasn't quite caught up here. And that is still one of the risks here, I would say, to the overall market. It did manage to get back above the 50-day moving average, but notice that 50-day moving average is starting to flatten. We're seeing the trend quality deteriorate here over the last week and a half. And the question is whether small caps can hold that 50-day moving average and continue moving higher, or it's at risk of further pullback here. That's definitely the part of the market that I think we need to keep an eye out on, specifically smaller cap, mid cap companies. They're just not overall fundamentally doing particularly well, even though that the major indices have this kind of bullish trend quality to it. The underlying market here has been relatively weak. This is the RSP, the equal weight S&P 500. As you can see, it's been below the 50-day moving average for over a week now. And even despite yesterday's rally here, we pretty much remain just at that 50-day moving average. So there is the risk that the rest of the market, does not follow through and continue moving on. And that is the overall risk that we see here to equities, is that you have a few growth tech stocks that are continuing to power this move higher, while the rest of the market really lags behind. We certainly are a little bit more concerned with regards to the bond market. If you look at HYG, the high yield corporate bond market, as you can see, it has started to fall below the 50-day moving average, even though yesterday it did manage to close back above it. Notice how basically over the last month and a half, or nearly 2 months, HYG has gone nowhere. There's definitely a lot more concern in the credit quality these days, versus in investment grade and junk bonds versus risk-free treasury assets. If you look at TLT, it pulled back to that 50-day moving average. It really has been a pretty poor bounce off that 50-day moving average. This starts to fall back below that 50-day moving average. That also puts bonds at risk, which would be a more of a risk-off signal here for the overall market. So we're not quite out of the clear yet, but there's definitely some improvements to sentiment from last week. So then taking a look at some of the opportunities for right now, I think the first one I want to bring up here is NVIDIA. NVIDIA had a really nice pullback here to the 50-day moving average that got bounced off of it. If you look at the business, NVIDIA is trading at around 28 times forward earnings, which is, if you think about the growth expectations for NVIDIA and how profitable they are, EPS and revenue growth is in the 38 to 40% range. There's almost no company of their size even holds a candle to the growth expectations that NVIDIA is expecting. And then you add on top of that the fact that net profit margins are north of 50%. There's just no company that is even remotely close to NVIDIA with regards to growth expectations and profitability. Yet it only trades at 28 times forward earnings. There are plenty of companies that trade far more expensive valuations. Even Apple. Apple's trading at 33 times forward earnings, and they're expecting to grow EPS in the single digits. And profit margins are about half as much as what NVIDIA is commanding. So that's really what I think creates a really substantial opportunity for investors in NVIDIA in buying that recent dip. It's just from a valuation perspective, it looks incredibly compelling here for NVIDIA to be a buyer. And the next one we'll take a look at here is FedEx. FedEx, as you can see, recently started to, as you can see, the trend quality has improved substantially here. Basically, since mid-October, the trends have turned green. Basically, ever since it broke out here above, this resistance level here, which is around 240, the trend quality has improved. We have a bit of a pullback here, and I think that is also another opportunity for investors in the long run. FedEx trades at around 14 times forward earnings. It doesn't grow as fast as its peers. Or sorry, it grows nearly as fast as its peers. It's really not far behind at all. And in terms of profitability, it pretty much matches its peers. Yet it only trades at 14 times forward earnings versus the industry is closer to around 19 times, which is why I believe there's a pretty substantial opportunity for FedEx, into that all the way up into the $300 range here to the upside, given kind of where the fundamentals are for FedEx. Next one I'm going to take a look at here is Gilead. Now this stock has, oh, sorry, this is not the right symbol for it. Now, Gilead, as you can see, what we're looking for was that breakout here above 120. Now, it did pull back here a little bit, just below that 120 level, but it has held that 50-day moving average. We're really looking for a continuation here above 120 and basically break above this double top at 124. So this is one that, we could be a little bit more patient and wait for that 124 breakout to be a confirmation of the continuation of the bullish trend. But what we really like about Gilead is the fact that it's expecting to grow EPS at about triple the rate of their peers, 23, 24% EPS growth versus around 7, 8% for the rest of the pharma industry or drug manufacturer industry. Revenue growth is basically the same as most of the industry, 3, 4%. But Gilead's actually net profit margins are well ahead of its peers, 28% profit margins versus 16 for the industry. So faster growth, significantly more profitable, yet it trades pretty much at the same valuation as the rest of its peers. And that's what presents the opportunity. And that's what leads me to believe that it does have the fundamentals to break out here above 124 and sustain that breakout here. But we have to see from a timing perspective whether or not right now is the right time for that. So this is one that's kind of on watch and I think is worth paying attention to. The next one I'll take a look at here is Pacific Gas and Electric, the utilities company. As you can see, basically since October, the trend quality has improved substantially here, had a bit of a pullback here to that 50-day moving average and is now turning green here again. So similar to Gilead, we basically broke out here above, call it the 15.5 level, broke out, traded in a range. And we're looking for that breakout here above 16.5 to the upside or 17 to the upside. Pacific Gas and Electric trades at 10 times forward earnings. They're expected to grow just as fast as their peers. It's not nearly as profitable. Net profit margins are 11 versus 14 for the industry, so it's a little bit behind from a profitability perspective. but it's trading at a 50% discount to its peers. So, I don't necessarily think a 3% difference in profit margin justifies a 50% haircut in valuations. And that's why I think there's an upside opportunity here for Pacific Gas and Electric, especially as it seems like this bottoming formation is starting to complete. If it can get above that 17, the short-term resistance, there is some short-term resistance around 17 and a half, 18, but if it can get above those levels, where I think, this can get up into the 20s to the upside. So Pacific Gas and Electric, I think in the long run, interesting opportunity. Meta, this is one that we continue to really like here in this market environment because of the valuations. So Meta, as you can see, traded all the way down to 600. So it's from a technical perspective, you've got a what we call counter trend buy signal, meaning the stock has sold off so heavily in the last few weeks that the opportunity for a bounce is much higher. But what really is compelling for Meta is the fact that right now it's only trading at 20 times forward earnings. That's extremely inexpensive if you consider the fact that EPS growth and revenue growth is expected to be 13% and 18%, which is really respectable expected growth. But what's really more important to me is the fact that profit margins are 31%. So when you have companies growing this fast with such high profitability, trading at only 20 times forward earnings, that's a discount to the average S&P 500 stock. And if you think about the average growth of the S&P 500 stock, EPS growth is probably in the 12% range, but revenue growth is closer to around 6 to 7%, and net profit margins of the average S&P 500 stocks around 12%. So you're well ahead of growth expectations, profit margins, yet it trades at the same valuation as the average S&P 500 stock. So I think this pullback here to 600 is a great opportunity for long-term investors to look at Meta. The next one we'll take a look at here is Fortinet. Fortinet, as you can see, recently did break below that 50-day moving average. So this is actually one that I probably would be more patient on. I don't think now is the right time to be a buyer, but if it can get back above that 50-day moving average and break above 87, that is worth taking a look at. And the last one that I want to take a look at here in terms of upside opportunity here is Alphabet. As you can see, Alphabet recently pulling back to that 275 level, we're getting back up to that double top here at 290s. I really like to see that breakout above 290. I think it's consistent a further move here in Alphabet because Alphabet trades at 25 times forward earnings, which is basically in line with the rest of the industry. So it's not as cheap as Meta, but from a growth expectation perspective, from the profitability perspective, almost identical to Meta. We're talking about EPS and revenue growth that's in the high double digits. So we're talking about 15, 16% EPS and revenue growth. And we're talking about net profit margins that are in the 33% range. Trading at 25 times forward earnings, I think, is still more than reasonable for a company growing that fast and that profitable to be valued at those types of valuations. And then let's take a look at some of the bear side of things. So the first one I want to take a look at here is Affirm. Affirm, as you can see, recently had a big move here to the upside, but that big move is still below that 50-day moving average. And that's really what I think presents an opportunity here for Affirm. So is that rally here presents kind of a bearish opportunity, in my opinion. If you look at the trend quality, it's been pretty poor basically since the end of September. It's turned quite bearish. And the story here is the fact that Affirm trades at nearly 85 times forward earnings. It's actually approaching 90 times forward earnings. So this is just a stock that's trading at, you could call it ridiculous valuations. The reason that it's trading at such ridiculous valuations, or one of the reasons that you can sort of justify a high valuation, is the fact that it grows very, very fast. EPS growth is in the 137% range. Revenue growth is in the 24% range. But the problem that I see with a firm is that net profit margins are very thin. We're talking about 6% profit margins. So when you have thin profit margins like that in a product that is generally speaking um, specifically geared towards uh, the lower income group, we're starting to see that lower income spend become a lot more sensitive to the slowdown in the overall labor economies. And that's really where I think we could see some slowdown in terms of revenue growth for a firm. And that's why I think the rally that we've seen here in this particular stock is an interesting um, opportunity for bears to take advantage of that. The next one I want to take a look at here is microchip. All right, so the next one I want to take a look at here is microchip. And as you can see, the stock recently broke below 60. And that was our thesis, was that this stock was going, as you can see, it was kind of trading in a range above 60. Our thesis is that it was going to break, and it recently did break and kind of had a little bit of a bounce here. And we're looking for that continuation lower here. Notice how that trend quality has been deteriorating. And just in the last week and a half, it turned fully red. And that was kind of what we're looking for, is that continuation lower here. Microchip trades at 38 times forward earnings, 39 times forward earnings, which is, about 30 to 35% above the industry average. And to some degree, you can justify a higher valuation because of the fact that it grows pretty fast. Revenue growth is in the 15% range, EPS growth is in the 41% range. But the problem with microchip is that it actually loses money. Net profit margins are negative. It's negative 4%. So for every dollar in revenue they generate, they lose 4 cents in net loss. Whereas the industry average is closer around 14, 15% profit margins. It doesn't grow as fast, but it's a big problem for companies like this that have issues from a profitability perspective. And I think that's why the stock has taken such a big dive here recently. And we're looking for that to potentially continue because in this type of market environment, when they're not profitable, we see some concerns with that. Next one I want to take a look at here is Apple. Like I said before, one of the reasons I'm a bear in Apple again. I was a bear in Apple back here. I was a bear in Apple back here. I was a bear in Apple, I think, right there. But when it kind of started to bottom out and started to break above, this 215 level here, it formed this bottom and broke out from this base. That's when I basically, from a timing perspective, felt that it was no longer the right time to be a bear on Apple. But now that we've had this rally from 215 all the way to 275, I think the opportunity to be a bear in Apple is back again, especially if you look at valuations. And notice how, despite kind of all the volatility this week, Apple has played a bit of defense here, and I'm looking for a pullback here in this because Apple trades at 33 times forward earnings, which is about 50% higher than its peers. Yet it actually is growing slower than its peers. EPS growth is only 10%. Revenue growth is 7%. So we're talking about pretty anemic growth for Apple. And then net profit margins are the only thing that's holding this company up from a valuation perspective. Net profit margins, at 26% is very strong. But I think that it's hard to justify a 50% premium to its peers when they're not particularly growing. And, Apple just has a lot of, I would say, fundamental problems with kind of from a product perspective. The fact that iPhone 16 was meant to be, the iPhone 15 was meant to be, no, I'm sorry, Apple 16 was meant to include the Apple Intelligence, and there was a whole marketing push behind that, to upgrade to the iPhone 16 because they were going to add AI to it. And now, we're well into the iPhone 17, and that is no longer a marketing um, uh, part of the phone, which, really speaks to just how far behind and how much they really dropped the ball on AI for their company. And then you add on top of the fact that their big gamble for the next um, device of AR, augmented reality, has also fallen quite a bit behind, even compared to Meta, which arguably has a better commercially viable product for AR. So for those reasons, I think Apple is really, trading at 33 times forward earnings, really priced to perfection, and is a concern for me at this stage. The next one I want to take a look at here is Kroger, the supermarket stock. As you can see, this stock recently, similar to Microchip, just broke below a major support level. The $65 level has been a major support level for a while. We broke below it, rallied back up to that level, and this is really where I think the risk to reward ratio favors short plays in Kroger's. It's not expensive. It's only trading at 12 times forward earnings, but supermarket stocks are notorious in terms of operating on razor thin margins, and Kroger's net profit margin is under 2%. So for every $1 they generate in revenue, they only earn 2 cents in net profits. And then you add on top of the fact that Kroger's is actually growing slower than its peers. EPS growth is only 8% and revenue growth is only 2%. That's a pretty meaningful, that's meaningfully behind their peers. So for those reasons, I think the fact that, Kroger's recently breaking down below that $65 level is an opportunity for bears to potentially another one I want to take a look at here is Spotify. So Spotify, similar to some of these other bearish setups here, as you can see, just starting to break below what is a major support level here, around 610, 615. So we broke down below it, came back to retest it. It hasn't quite seen that big break to the downside, but this is really starting to look like it could crack and break it, get down to that $500 level. And Spotify trades at 46 times forward earnings. You compare that to the industry of 25, we're talking about nearly double the valuation. And some of that can be explained by the fact that EPS growth is expected to be in the 40% plus range, but revenue growth is really in line with the rest of the industry, and profitability is also in line with the industry. So just because EPS is meant to grow at a healthy clip, I think it's hard to say that justifies a 100% premium in its valuation. And I think that's what investors have been concerned about over the last 3 months, as Spotify has actually underperformed the S&P by a pretty significant margin here over the last couple of years. And then lastly, I'll leave you with is Philip Morris on the bearish side. Philip Morris continues to disappoint. As you can see, basically ever since it broke below that 50-day moving average, we've been looking for rallies into the 50-day as opportunities to sell. And that's exactly what we're getting here again, is a rally into that 50-day. We're looking at that as an opportunity to seek some bearish exposure here. Philip Morris trades at around 18 times forward earnings, which is about a 20% premium to its peers. But if you look at growth expectations, you look at profitability, it's really not expected to grow much faster than its peers. But what concerns me the most is the fact that profitability is really far behind its peers. Net profit margins have tanked to 21% versus its peers is still around 33%. So when you're not growing very fast, and then you have profit margins that have compressed significantly over the last few years, that's really why the stock has been under pressure and continues to be under pressure. And this rally, I think, from a timing perspective, is an interesting time to be seeking some bearish exposure here for Philip Morris. So with that covers what I wanted to share with you here today. We are in this stage of the market where there's reasons to be cautiously optimistic, but there's also, if you look at the market animals, you look at market breadth, it is not particularly strong at the moment, and there is some risk to the downside. That's small caps and the rest of the market doesn't play catch up and doesn't continue moving higher here, and that will create a drag here on the overall markets. May not necessarily be a bearish view, but it certainly will create a drag here on the overall markets. And I think that is really what we have to pay the most attention to see if that drag continues or if it plays catch up. Because if it plays catch up, it does provide the catalyst for the markets to make new all-time highs and continue the bullish momentum. Otherwise, we do have the makings of what could be, the start of a market top. With that covers what I want to share with you here today. I hope that this gives you a better understanding of how we're viewing the markets. And I will see you guys next week. Thank you so much.